welcome. Today I'm going to discuss the stock market and what it is. I'm sure you've heard from time to time the news media talk about the stock market being up or down. What is it? What does it do for us? What does the media tell us if it's up or down? How are we supposed to use this information? What does it all mean? So first thing is, what does the stock market refer to? When someone says the stock market, we're referring to popular indices that I'll discuss today, and daily and their point swings bring media attention, especially when the point swings are down significantly. So these are not actual markets. They're trackers or indexes, and they replicate the actual markets. Every stock listed in the index has its own market. Buyers and sellers come together, and that makes a market. So a market for stock is about 4,000 of them, because that's how many publicly listed companies trade when stock markets are open. You can't buy the actual indices that I'm going to discuss, but you can buy and sell any of the companies listed on these indices. Why do we have stock markets? Again, what are they used for? So they're used as leading economic indicators, and they tell us the direction of the economy, and they're forward-looking. So it's not something that the stock market doesn't tell you what's already happened. It's a prediction of the future. So when stock prices appreciate, companies are growing. That gives managers of those companies the ability to reward their employees with more pay. And with more pay, those employees go out and spend more money on the economy. Investors, us investing in those stocks, when those stocks gain in price, then we are gaining wealth. And overall, that's good because it gives us confidence to spend money in the economy and reinvest, have more money as a result, and our economy does well overall. When stock market declines, the opposite is true. So we feel poor. We feel like we're losing our wealth. So we're losing confidence. And as a result, we don't spend as much money in the economy. So when stock markets are losing value consistently, not just day to day, that might be an indication that a recession is on the horizon. The news media, once again, covers the stock market more so when it has significant declines. It's sensationalism in a way, and it plays into our natural inclination to loss aversion. You've probably seen headlines such as these, but you've never seen a headline that, for example, says the stock market has gained 23,000 points in 10 years. It's long term. Nobody cares day to day about the long term. We care more about the current. Okay, so companies listed in the stock market vary in size. We know that there's very large companies and very small companies. So you could be a publicly listed company, a small company, or a very large company. How is it determined, the size of the company? So this is what's known as market capitalization, or market cap for short. So there's small, medium, and large companies. Typically, a small company will be valued at under $2 billion, while a mid-sized company will be between $2 billion and $10 billion. A large company stock will be valued at more than $10 billion. And you would think that would be enough, but no. Due to the growth of companies such as Apple, Microsoft, and Amazon, the term mega cap was created, and that further distinguishes very large companies from just plain old large companies. So to be a mega cap stock, you have to have a value of more than $200 billion. Familiar stock market to many, for many generations now, is the Dow Jones Industrial Average. And most of the time when the media talks about the stock market, most of the time is referring to the Dow. It's also known as a blue chip index. I'll discuss that in a minute. But this index, which was created in 1896, only tracks 30 stocks. And of the three major stock indices, it is the only one that is weighted by price. So the price of the stocks, of the 30 stocks, determine the direction of that stock index. And until it was removed in 2018, General Electric had been the longest listed company in the Dow. And then it was removed, and Procter & Gamble now holds that title. It's the oldest company in the index, making its first appearance there in 1932. More recently, Amgen and Honeywell were added in 2020. So again, the Dow is the most widely watched index in the U.S. for a couple of reasons. One, it's the oldest one, so it's just been used for a long time. And the other reason, I think, is that it trades at a high point value. So currently, it's at about 35,000 points. So when the stock market, measured by the Dow, moves a few hundred points, then it's just more exciting for the headlines to say the stock market fell, or more likely than not, plunged by 300 points. But these days, a 300-point move down, so-called plunge, is under 1% of the index value. But again, it sounds more exciting than saying the S&P 500 fell by 40 points. It's still 1%, less than 1%, but it's only 40 points. Okay, blue chips, what does that mean? So the term blue chip index, again, refers to the Dow. It was first coined in 1923, and it comes from poker. Poker players bet in blue and white and green and red chips. So the blue chips have the most value. So in 1923, someone referred to the stocks in the Dow because they were gaining so much value at that time. They referred to them as blue chips because of the high price ticket of each of those stocks. Today, that blue chip doesn't refer to high price stocks. It more refers to the high quality of these companies. High quality meaning that they've stood the test of time and strong financials, solid business model, those types of things. So unlike the other two major indices I will discuss shortly, the Dow is, again, calculated based on price. So when you have a dollar move on the price of one of the 30 components, then that 1 point move reflects in the actual identical move of the index. So whereas the Dow only tracks 30 stocks, the Standard & Poor's 500 index tracks at least 500 companies, and you'll be very familiar with a lot of the names in that index. Very well-known companies, very big companies. This index was created in 1957, and it represents the 500, give or take, largest companies in the United States. They must meet a certain criteria to be listed on that index. It's determined by the publishers of the index, if you can be listed in their index fund or in their index. So before being added to the S&P 500, for example, you must have at least 13 billion in market capitalization. So it's a market capitalization weighted index. So that the higher your market capitalization, the bigger percentage that you're going to make up of the actual index. So the largest cap companies make up the largest holdings in that S&P 500 index. So as companies have grown and industries have grown, so does their weight in the index. For example, technology makes up 28% of the index today. But if you go back to the 1980s, energy stocks made up 28% of the index. As of the end of last year, 6 companies made up 50% of the Standard & Poor's 500. And in order of market cap, you have Apple, Microsoft, Amazon, Google, Tesla, and Facebook. So the NASDAQ is another widely followed market capitalization weighted index like the S&P 500, and it contains more companies. It contains up to 3,000 companies, and it's not all large cap companies, but large companies do make up 76% of the index. It's the newest of the 3 indices I've spoken about so far. It was launched in 1971. Unlike the Dow and the S&P 500, which focus solely on U.S. headquartered companies, the NASDAQ contains some foreign companies. The NASDAQ is also seen as a stand-in for the technology sector due to its heavy weighting in the technology companies. Currently, they account for about 43% of the index. If you go back in time, it was an over-concentration in the tech sector that drove the NASDAQ to peak at 5,000 points back in March of 2000. And the subsequent decline were so steep that the 5,000 point level would not be seen again till 15 years later. So this was the dot-com craze and the dot-com crash. Among the 15 largest companies listed in the index back then, only 4 remain in the top 15 holdings today, and that's Microsoft, Cisco Systems, Intel, and Qualcomm. The composition of the NASDAQ back then was 65% technology stocks. Today, again, it's 43%, so it's changed somewhat. So these indices all focus on large and mega cap companies. And again, the reason we have stock markets is to get a forward read on the health of our economy. But are large companies the only gauge we should be using as investors? I think the health of smaller companies should also be included into the readings into our economy. So for that, we have the Russell 2000 index. This index was launched in 1984, and it measures the results of 2,000 smaller companies. It's also weighted by market capitalization. So everything I've discussed today, why does it matter? What do we do with it? Is there a strategy? Is there a time to invest in small companies or in large companies? And so we can isolate some periods of recent economic cycles, and you'll see that during certain economic cycles, large company stocks work well, and others, small companies work well. And I think it'll surprise you that during downturns, small companies tend to do better. Because if you think about large companies, you think they would be able to withstand economic downturns with all their resources much better. But let's start with the 1979 to 1983 years. These years were marked with high inflation, double-digit interest rates, and back-to-back recessions, January through June of 1980, and again in August 1981 through December of 1982. The Russell 2000 outperformed the S&P 500 in that period of time by 80%. You could read into that by saying investors judged that smaller companies navigated the environment more nimbly than larger ones. Then we have a long expansion period that began in 1983 and went into the early 1990s. Large company stocks rebounded, leaving small companies in the dust. During this period of increased certainty in our economy, the Standard & Poor's 500 beat the Russell 2000 by 91%, more than recovering its 1979 to 1983 underperformance. Then came the 1991 recession and its immediate aftermath. Small companies once again outperformed the S&P 500, this time by nearly 50%. 1994 to 1999 marked the strongest phase of the 1990s expansion. Standard & Poor's 500, large company index, again beat the Russell 2000 small company index, just like it had in the 1980s booms. This time, the S&P 500 beat the Russell 2000 by 93% over 5 years. So then we have a new era of turbulence, 1999 to 2014. That included the tech wreck, the September 11th attacks, Afghanistan and Iraq wars, the subprime mortgage bubble, economic meltdowns, and quantitative easing. Well, during that period, small company stocks swiftly outperformed large companies. Russell 2000 beat out the S&P 500 by 114%. You could point to the big banks as being the culprit as to why the S&P 500 did so poorly. Of course, they were too big to be listed on the Russell 2000. You might remember the phrase too big to fail. Well, big referring to the market capitalization. So they lost a lot of value. A lot of them lost all their value. And so as a result, by the nature of the large cap size, the S&P 500 had a bigger decline than the Russell 2000. Since 2014, however, large company stocks have outperformed the Russell 2000 once again. I think much of it has to do with the growth of the aforementioned technology companies such as Apple and Amazon and Microsoft. And you could say, there's small companies that are in tech as well, but certainly that the size of these companies, Google, Microsoft, Apple, has become, into the trillions of dollars, and they've listed on the S&P 500. The COVID-19 pandemic hit small company stocks especially hard. Few among them were ready to go with online delivery services or other entities that have proven to be relatively insulated from this latest crisis. Where we are currently, small company stocks are showing a much stronger reaction to the news regarding the end of the lockdowns than have the large companies that benefited the most from the lockdown environment. So that's all I've got for you today. Thank you. And please join me soon for another lesson. you.